Welcome to our weekly USD/CAD analysis. This is your report for December 1st to 5th, 2025. This week we witnessed a dramatic bearish reversal as strong Canadian jobs data shattered the market structure. We'll break down the technical collapse, the fundamental drivers, and what this means for traders in the short and medium term. Stay tuned as we explore the key levels and strategies to navigate this new market environment. This report was prepared on December 8th, 2025. This week was defined by a stunning bearish reversal. USD/CAD plummeted from its November highs, shedding nearly 2.2% in a dramatic move. The week closed at 1.3761, marking one of the most significant weekly declines since May. The primary catalyst was a blockbuster Canadian jobs report, which completely shifted the market's technical and fundamental outlook. The long-standing uptrend from July has been decisively broken, signaling that sellers have taken control. The game changer this week was Canada's jobs report. Against expectations of a 1,500 job loss, the economy delivered a massive beat, sending the Canadian dollar soaring. This, combined with rising expectations for a Federal Reserve rate cut in December, now at an 88 to 90% probability, created a perfect storm. The policy divergence between a dovish Fed and a potentially hawkish Bank of Canada is now the primary driver, putting structural pressure on USD/CAD. Technically, the floor gave way. The price crashed through the 100-day moving average at 1.3900 and the critical 200-day moving average at 1.3889. This breach of long-term trend indicators is a major bearish signal. Furthermore, the uptrend channel that has supported the pair since July was shattered. This wasn't just a dip, it was a structural breakdown, confirming a shift in market control from buyers to sellers. With the breakdown, former support levels have now become formidable resistance. The most critical zone to watch is between 1.3889 and 1.3900, which represents the breached 100 and 200-day moving averages. Any rally attempt is likely to face significant selling pressure here. Further resistance lies at 1.3970 and the 52-week moving average around 1.4010. As long as the price stays below this critical 1.3900 zone, the bearish outlook remains firmly in place. For the next 1 to 2 weeks, the outlook is bearish. With the technical structure broken, the path of least resistance is lower. The immediate trading range is expected to be between 1.3734 on the downside and 1.3900 on the upside. The primary strategy is to sell rallies toward the 1.3889 to 1.3900 resistance zone. The initial target for sellers is the 1.3839 level, with a more significant target at the 1.3734 to 1.3768 support area. Over the next 1 to 3 months, the outlook has shifted from bullish to neutral to bearish. The rally from the June lows appears to have completed, and we are now in a corrective phase. The key level to watch is 1.3734. A sustained break below this level would confirm a larger bearish reversal, opening the door to targets at 1.3669 and even the June low of 1.3538. Until then, expect choppy, corrective price action within the broader 1.3734 to 1.4139 range. The core fundamental story is the diverging paths of the Federal Reserve and the Bank of Canada. The Fed is poised to cut rates, weakening the US dollar's yield advantage. In contrast, strong Canadian data is fueling speculation that the Bank of Canada may be forced to adopt a more hawkish stance, or even consider hikes in 2026. This narrowing interest rate differential is a powerful structural headwind for USD/CAD, supporting a weaker exchange rate going forward. For day traders, the strategy is to sell rallies into the 1.3889 to 1.3900 zone with tight stops. Swing traders should also look to sell rallies, using a wider stop above 1.3970, targeting the 1.3734 to 1.3768 area. Position traders with a bearish bias should maintain short positions, with a stop loss placed above the 1.4010 invalidation level, looking for an eventual move toward 1.3538. The key risk management rule is that the 1.3889 to 1.3900 zone must hold as resistance. In conclusion, a bearish reversal is confirmed. The technical breakdown, driven by a powerful fundamental catalyst, has shifted control to sellers. The short-term outlook is bearish, with rallies expected to be sold. The medium-term trend now hinges on the 1.3734 support level. All eyes will be on the upcoming FOMC and Bank of Canada meetings, as monetary policy divergence will continue to be the dominant theme. Trade safely and respect the new bearish market structure.